Okay, so let's start off. Today, our focus is going to be on debt capital market and debt capital market instruments. Last week, we specifically, before we venture into debt capital market, we had an introductory lesson on what capital market was on a broader scale. What capital market means, what is its importance to the financial markets, to other financial markets, to the financial system as a whole, who are the participants that we could see in the financial markets, and how is financial market trading happening. Okay, so there we saw trading in a capital market happens in two ways, through the primary market and through secondary market. We saw why capital market is split into these two segments and how each segment is important. One cannot operate without the other, especially considering the capital market. Main reason why we have a secondary market supporting the primary market is the requirement for liquidity. And what are the functions that we see in primary market when it comes to new issuance? We saw that by going through the prospectus, the practical prospectus that was issued recently. We went through how each of the functions that we studied theoretically is executed on a practical way. And then we moved into secondary market. What happens in a secondary market? Who are the participants we see in a secondary market? And there we saw important trading concept called margin trading. And finally, we finished the entire chapter by studying the importance of why we need the secondary market. So if you see our lecture pattern, we started with the theoretical background, then we are now focusing into financial market in particular, where we see into each particular financial market. We started off with money market. Money market is a debt market, but it's a short-term debt market. We finished that. Now we are moving into the long-term market. In the term, we see that not only debt is long-term, there is equity as well. First, we saw an introductory lesson that we saw last week. Today, our focus is going to be about, yes, long-term markets, but we are going to focus on debt capital market. So after we finish this particular lesson, it won't finish off in a week. It's a very lengthy chapter. After that, we move into equity market. Okay, so for another, let's say 3 lectures or 2 lectures, our focus is going to be on debt market, where we're going to see long-term debt market on how it is structured and what are the instruments that we get to see here. Okay. All right. So before we start off, just to remind you all on what's happening, I hope you all read news about what's happening. So this week, in the monetary policy meeting, we had in the monetary policy stand. Even not only for your exam, but even as a banker, you have certain customers approaching you and asking, okay, what does this mean? What this announcement, they might not know what it means and what its repercussion. So you need to explain to your customers, look here, now central bank is moving to a more tightening monetary policy. So far they have more relaxed monetary policy, where rates were less. Now going forward, we can see an increase in market interest rates. So especially if you take the statutory reserve ratio, earlier it was 2%, now banks are required to keep up to 4%. So there's a 2% jump in their margin requirements, in the reserve requirements. So that alone, we could see FD rates picking up, lending rates picking up in the market. So you need to be aware about it. If one of your customers approach, you need to be, having the knowledge to educate them as well. So this announcement came in on Thursday. I think it is on Wednesday. Thursday morning, early morning. This announcement came in. And then you could see by Friday, we have AWPLR moving up. We didn't see such a on 5.8 level increase so far. So in the next coming weeks, we can expect interest rates to move up, especially FD rates. Okay. So 5.87 is like compared to, I think, from the beginning of the year, relatively a very high rate because it came drastically declining, and we were stagnated at the 5% level, and at the 5% level, it's like the peak that we see now. In coming weeks, it would move up. Okay. So understand what it means. Bank website. On the main banner, this is the latest article that keeps running. You click on that and then you get the full text. Okay, something is wrong. If you click on the full text here, you will get the article. There you will be able to read the justification that central bank put forward as to why they had to increase the interest rate. That's also something that you need to read up, not only for my subject, but even for you as a banker to build up your knowledge on what's happening in the economy. It's a good read. Okay. So before we start off the chapter, let's set up our mind on what we are going to look into. Our focus is going to be about debt capital markets. So throughout these three lecture series, what we are going to see is the long-term instruments, and these are debt instruments. Remember, the debt capital market is sometimes referred to as the credit market or even the bond market, just other names that they could call it. But here, when I refer to the word debt capital market, what you need to keep in your mind is, what you need to pay attention is, yes, in this market, we are going to see products, so we are going to see instruments which are going to have a maturity of more than 1 year. Okay, that's something that you need to have in mind. Another thing is, here, one of the main participants that we're going to see are corporates and the government. Now, this is the similarity we saw with money market as well. Money market also, one of the main issuers were, yes, corporate and government. Here in debt market, in debt capital market, we also see the same feature. But here, the maturity that we're talking about is going to be more than 1 year. Again, like what we discussed last year, because this is a segment of the capital market, even in the debt capital market, you can see primary debt capital market and secondary debt capital market. So primary market essentially handles the new issuances, where the issuer and the initial investor gets involved. Secondary market is where investor to investor, the trading and the transactions occur. Okay, so another secondary market is ideally present to support the primary market and give the liquidity. So I was explaining the importance of debt capital market. Why we need a debt capital market. Now there you see points over here. Certain points you would see that these coincide with even the other factors that we saw as to why such markets were important. But one major reason why we need a debt capital market is this market caters a requirement that the other markets don't. That is the requirement for long-term capital. If you take the government, for the government to approach the money market was to service their recurring requirements, their recurring fund requirements. To run the government, to continue their initiatives as it is, they would tap into the money market. Okay. but they tap into the debt capital market to find funds to raise capital for their development initiatives. It can be for infrastructure related, welfare related, but for the project finances, the market that they would enter into is the debt capital market. They won't get into the equity market because, as I explained you last week, they can't tap into that market as an issuer. They could go as an investor, but not as an issuer. Okay. Similar to that, even for corporate, money market gave them the or satisfied the purpose where they could enter into that market to meet their working capital requirement because it was short term in nature. But if their focus is to expand the business, to develop the business to the next level, then does money market serve the purpose? No. If they want to achieve that, where they need to develop the business, expand, and they choose debt funding as their source of finance, yes, they would have to tap into the debt capital market for this requirement. So one of the main importance of having this market is to meet the long-term capital requirement of both government and corporates. Okay. Participants in debt capital market. Participants we saw again last week. If a capital markets, mainly we see corporates, governments as the issuers. Okay, they become the main issuer when it comes to a debt capital market. You could see financial institutions also coming in on board, especially recently where banks were issuing debentures to meet their capital requirement. And in some countries, you have multilateral agencies tapping into their debt capital market where they issue foreign bonds and euro bonds. Okay, but the significant issuers that you could see in this debt capital market is companies and governments. Investors. For a debt capital market, investor is usually an institutional investor. You will have investment funds, pension funds, insurance companies tapping into this market because their risk appetite or their maturity appetite is for a long-term investment. Okay, they have a larger fund base where they could allocate larger sums of money or invest larger sum of money for a long tenure. So then you will see most of the institutional investors tapping into debt capital market. What about individual investors? You would see one or two, but mostly they would be high net worth individuals tapping into this market. So main investor that you would see is institutional investors. Managers. Now last week when we went through a prospectus, I told you, I showed it to you as well. You had certain specialized financial institutions giving support to the issuance, especially in a primary market, giving you advice on how to structure, how to arrange, how to market this issuance, when to market this issuance, how to distribute or how to reach to the investors. Okay, so I was explaining agent and trustee. Agent and trustee are two different entities. They have two different interests. So what an agent does is, for agent, they are a representative of the issuer. Okay, their motive is to ensure that issuer's interest is met. For trustee, the motive is to ensure investor's interest is met. Okay, why do you need an agent and trustee when you have an issuer and an investor? There can be certain instances where the issuer is unable or does not know how to deal with the particular arrangement. So on behalf of an issuer, agent could step in and perform the work so that the issuer's work is smoothly completed. Now, you see a agent coming into a debt capital market arrangement a bit, very rarely. But trustee is someone that you would see more frequently in a debt capital market. Why? Because there are several investors and they tend to be fragmented. They don't know who the other person is. So in a situation where investors' interest needs to be emphasized, need to be ensured, you can't have 100 of investors coming in, getting into an argument with one issuer. So to have a proper discussion with the issuer, you would send up a representative. You would set up a representative called the trustee. So trustee, what do? They ensure that the issuer acts in the promised way. Now, issuer would have said, okay, look here, there is a debenture I'm issuing, I would act in these manner. So a trustee would step in and see whether the issuer is actually doing that. Now, sometimes he would have given a collateral, and the collateral would have certain conditions. Okay. Now, trustee will ensure that these conditions are met. Why? If the condition is violated, who is going to be at a loss? The investor is going to be at a loss. Can 100 of the investors coming and check each and every condition? Difficult. So a trustee could be appointed so that their interest or investors' interest is met and safe. Okay. Finally, you have trading infrastructure platforms. So these are the platforms available to execute or to do the debt capital market trading smoothly. It includes the stock exchanges. In certain situations, it can be a decentralized market. Okay. So those kind of setup, the trading infrastructure, even the payment setup, form as a part of a participant in a debt capital market. But remember, manager, agent, and trustee, trading infrastructure, the last three are always the supporting entity. They support this arrangement. The main critical participants tend to be the issuer and investor. All right. Advantages of debt financing and disadvantages of debt financing. Now, last week also we saw, when we talk about capital market, there are two main capital market. You will have debt capital market and you will have equity capital market. Okay. So as an issuer, now I told you mainly you will find two issuers: corporates, governments. Now for the government, it's an easy choice. Can they issue equity instrument? No. So for them, if it's a long-term requirement, only path to go is the debt capital market. But for a corporate, they have two ways to go. They can select equity as an option, or they can select debt capital market as an option. So in this choice or in this decision making, what are the advantages of moving into debt financing and what are the disadvantages they will have of moving to debt financing? Main advantage for debt financing is the tax advantage. What is this tax advantage? For debt instrument. Debt instrument meaning something like a loan. You are borrowing. Okay. You borrow where it means that you're obligated to pay back. You have to pay back. You can't say no. But for equity, no. Equity, it's not an obligation. You are selling the ownership of the company and taking in money. So the new person becomes part owner of the company. So you're not obligated to pay back the capital that he has invested. Both debt capital and equity, if you take for debt, you need to give them something. Now, you can't just take 100 million and pay back 100 million only. You have to pay them interest. For equity also, person will put in capital. Why? He will want something in return, dividend. If you take interest and dividend, interest as per tax accounting purposes is allowed to be deducted from the profits. Okay, interest for tax purposes, they consider it as an expense. Interest is an expense. Why? You borrow to run the company. Dividend is a payback to the owner. Owner has put in capital, company earns profit. Part of the profit is given to the owner in the form of dividend. So dividend for tax purposes is not allowed to be deducted from the profits. You can't deduct it before paying any taxes. You have to calculate the tax from the profit, pay the tax out, and whatever remains you can issue as dividend. So after tax only you can declare the dividend. But interest, you can deduct the interest, and whatever remains you calculate your tax and you pay the tax. Now if you have interest or if you have any debt financing, you have this advantage of deducting that amount before calculating for tax, which means your tax payment is going to be lesser. That's why it says a tax advantage. Due to this tax advantage, debt financing becomes a low cost financing. If you actually take the benefit that you get from the tax purposes as well, debt financing becomes a low cost financing technique in comparison to equity. The next biggest advantage that debt gives us is the predictability and certainty. Now think, if you take a loan, you know the particular days in which you have to pay your installment. You have an indicative, at least they will say this is your interest rate. Sometimes it can be fixed. If it's a fixed interest rate, better. You know for certain this is going to be your interest amount. If it's a floating interest rate, still you're able to get a calculated round up figure as to what your interest would be. So you know your outflow. You can predict what your payment is going to be like. But if you take equity, dividend, you can't predict as such. There can be continuously the same dividend being paid out. Now let's say a company has been paying out 2 rupees per share every year. Now if COVID hits, lockdown through about, let's say, 6 months of the year was under lockdown, can they still continue to pay 2 rupees per share? Difficult. So in that particular time, your investors are going to be demotivated, discouraged, and you would have if you're going to satisfy them and pay the 2 rupees, you will have cash flows issue. So there, predictability and certainty is not available. The dividend payout depends on the profitability. Okay, but here you know this is a commitment and the committed amount is already known to you. That becomes your advantage because you can easily account for it and prepare for it. That leads to the next advantage, easier planning, because you know your commitment ahead, you know when to finance it, how to finance it. Now you know mid of the month I have this loan to pay. Whatever happens, I have to pay that. So you will have your prior arrangements in place because you know for certain this is the amount and this is the time that you are going to pay. Finally, a biggest advantage of debt financing is retaining the control of the company. Because you're issuing a debt instrument, the one who's investing doesn't become the owner of the company. They can't directly control company's decision. So the company and its investors, the company's shareholders, are able to retain their control, maintain the same control that they had by issuing debt financing or by issuing debt instruments to the market. What would happen if they go for equity financing? Let's say I am the sole shareholder of a company. I need to expand, put up another factory. I issue a debenture. Let's say 5 of you invest in that debenture. Now you will have as a creditor, now you all are creditors. You all will have, okay, ensure interest is paid, like that. You will have certain demands. But you can't influence my decision making. I have control on how the company is running, where I will put the factory, what happens, the decision making would be mine still. But let's say I go for equity financing. I am the sole shareholder. Now I'm issuing additional shares to 5 of you, and another 5 shareholders are now coming on board. Now there are 6 of us. Can my decision alone matter? Even I can be a majority shareholder, but there will be 5 of them combined who will have a different opinion. So one decision has to be taken to run the company, to take the company decision. So for equity financing, control will be diluted. Debt financing, it doesn't happen. You get to retain the control and ownership. Okay. So what are the disadvantages of debt financing? Now, debt financing is a loan, commitment to repay. So when there is a commitment to repay, the person who's giving you the money, the lender, would want to ensure, can this person repay? He wants some kind of idea, some kind of a surety saying, okay, the person I'm lending to has the strength to repay, which means there is a requirement for credit rating. The lender would want the borrower to be credit rated, to have some kind of a credit rating to highlight their ability to repay. It's a mandatory requirement. If you are a company who's issuing especially listed debentures or even sometimes unlisted debentures, you have to get a credit rating to indicate your ability to repay. Now, credit rating means you can't just get into a credit rating agency and say, okay, give me a rating. You have to pay for it. There'll be assessments, forecasts done. There is a amount that needs to be spent and a time cost as well. Okay. So that becomes a disadvantage of debt financing. In addition to that, there sometimes can be a requirement to provide collateral. You have to give security for the debt financing that you're going to issue as a safety buffer. Okay, now that happens if you have an excellent credit rating, you don't have to give a collateral, obviously. But let's say you have not such a great credit rating, there is somewhat of a credit risk to this borrower. So to mitigate that, you might have to couple with a collateral. So then you will have to have a collateral which is worthy enough for the lenders. Cash flow. Now, if you take too much of debt financing or if you're too much into debt as a source of funding, there'll be a lot of committed repayments in your cash flow. Mandatory repayments that you cannot neglect. What will that cause? It will cause a strain to your cash flow. Why? There are certain fixed commitments that you cannot ignore. So, moment your cash inflow gets fluctuated, but your outflow is committed, that requirement doesn't change, you are at a risk. Why? You have to meet that cash flow. Now, this risk happens if you take too much of debt on board. Okay. Now, if your gearing levels are sufficient, if it's on a healthy level, this won't be a bigger disadvantage to you. But let's say your gearing levels are skyrocketing each year, which means you might have to borrow to repay your earlier borrowing. That kind of a situation. Okay, that poses a threat to the company's survival. Finally, remember, earlier it was an advantage, the predictability and certainty. You for sure know this time of the month I need to pay this amount. That becomes a disadvantage to you. Why? These are fixed payments. You cannot default. There can be lockdown, whatever it is, curfew, you can't move in, whatever it is, but you are committed to repay. Let's say dividends, equity, are you mandated to pay like that? You can defer it. Or sometimes there are companies which say, look here, this year profits were not so great, we are not declaring dividend. They have the authority or they have the power to give that announcement. But can a company come and say, no, I'm not paying any loan commitment this year? The lender has to agree. If the lender provides you with a moratorium, yes, you're great. But if not, you are committed to repay the loan amount. If you default, it becomes an indication of your credit risk and impacts your future credit rating. Okay. What are the two main types of debt capital market instruments? Mainly, you see bonds and debentures. Now, bonds and debentures, sometimes the people use it interchangeably, but on a theoretical way, these two are different. Okay, we are going to see their differences. Now, bonds are mostly issued by governments, and these instruments are long term in nature. Their horizon is medium to very long term, or let's say 30 years as a maximum is what they're looking at. But debenture is between 2 to 5 year range. Theoretically, even that's the tenor that they look at. And debentures are mostly issued by companies. Okay, corporates come into debenture issuances. Now let's see the finer differences in detail. Bonds. Theoretically, even they say bonds have a or collateral being plugged on. They are secure in nature. Debentures can be issued with or without collateral. Even on a practical way, I can't remember a prospectus which has both, but I'll try to show you an article. I think once there was a private debenture placement that where you will see one debenture being secured, one debenture being unsecured. So debenture you can issue on both ways, with collateral or without, but bonds usually come with a collateral in place, or if they don't, it means that it's issued by the government where credit risk is very low or nil. All right. Bonds are issued by governments. There sometimes can be bonds issued by corporations which are owned by governments as well. Debentures are usually issued by private corporates. The tenor horizon for debentures is usually a maximum of 5 years. So their tenor is between 2 to 5 year range. But bonds are very much into long term. You could see between, let's say, 5 to 30 year range is where you would see most of the bonds being issued. Because bonds tend to be secure, or issued by governments which have zero credit risk, bonds are considered to be very much less risk in nature in compared to debentures. Due to the less risk, bonds tend to give you low interest in comparison to debentures. Okay. Now here I said usually 5 years. Sometimes practically you could see certain anomalies, but on a theoretical way, when we go through, we say that's the usual benchmark. Why we say usually 5 year is, now see, 5 years from today, if a company issues a debenture today, maturity happens in 2026. The underlying understanding is that, okay, this issuer, this company is strong enough to survive another 5 years. Something that, okay, that stronger issuer only would come up with a 5 year debenture. Okay, and a 5 year horizon is somewhat comfortable to the investor. Why? It's long term, yes, but it's something that they could, the appetite is okay for 5 years. For the next 5 years, if it's especially listed, they have a way to get out of the debenture as well. You don't see debentures more than 5 years very often. But recently, we had LOLC Holdings coming in for a 10-year debenture. I think that was one of the landmark debentures we saw for a 10-year time period. Okay, for such a long tenor, and it did get subscribed, but it was one of the debentures which had such a long tenor. Okay, so understand, even though we say 5 years, there can be sometimes which are more than 5 years, but very rare. I think that was one of the only issuances we had for debenture to be such a long tenor in nature. Now we are going to start off with bonds, the types of bonds, risks of bonds, and so forth. And then we move into the debentures. What are the types of bonds that you see? Of course, you see treasury bonds. Who are the issuers? The government. Obviously, government, if they issue in their own domestic currency, we consider the treasury bonds to be default risk free. Sukuk bonds. Sukuk bonds are bonds which are issued compliant to the Sharia law. Now, Sukuk bonds has a separate part in your lecture series where we will go through what a Sukuk bond is and how that issuance happens. But Sukuk bond, right now to explain to you, it is a type of a bond which has features of equity embedded. Now, if you know the Muslim law, interest is something that they don't accept in that particular, as per their religious belief. Interest is not something that they accept on the banking term. They are okay for a profit sharing ratio. It has to be a result of something without just money being kept and earning an interest. Okay, so Sukuk bond is structured in such a way where the return is a profit. It's not an interest per se. Okay, so if it's a profit that's coming out, profit is linked to a ownership. Okay, so the way the Sukuk bond is structured is very different to how the other bonds are structured. It has features of both equity and debt embedded to them. Corporate bonds, you don't see in Sri Lanka much, but abroad, yes, there tend to be bonds issued by companies for very long-term financing. Convertible bonds. Convertible bonds are where from issuance until it matures, it continues in the form of a bond. It continues in the form of a debt capital instrument. But on maturity, the investor, or on maturity, the person who's holding the bond, the lender has the choice of converting into equity or asking the principal back. They have that option. They can exercise where they can convert their bond into equity, or they could say, no, I don't want equity, I need my money back. So convertible bond have the option embedded on them to convert the bond into equity on maturity. Okay. Highlight here is convertible bond is from the time you issued the bond until maturity, the form is pure debt. It is a debt instrument. It is on that maturity date that the investor gets the choice to convert it into equity or not. Sukuk bonds are not like that. From the time they are issued, they tend to have both features of debt and equity embedded on them. Okay, that's the difference. Green bonds. When you go through certain text, you might see this word called green bond. Here the highlight is, yes, it's a bond that you issue, but you call them the green bond because of the purpose of issuance. Now I told you government can issue bonds for their long-term capital requirement. Okay. But if their long-term capital requirement is for a sustainable related project or an environment related project, then the bond that they issued for this purpose can be termed as a green bond. Okay. Now recently, if you went through, you would have seen a company going for waste to energy related project. Okay, where they convert waste into energy and sell it to electricity board. Let's say to do the project, they want to raise money and they issue a bond for that purpose. Let's say the government is issuing a bond for this purpose. That bond, because the money raised by this bond is going for an environment and a sustainable related project, the bond can be termed as a green bond. Okay. Callable and puttable bonds. Now this is the main type of bond that you need to be aware of. Okay. Now callable and puttable bonds are certain options given to the issuer or the investor for their safety or for their interest. Okay. Now let's see this scenario. I am an issuer. Okay, I am issuing a bond for certain project development, and currently the market interest rates are, let's assume the market interest rate is going between 12 to 15%. Okay, so when I'm issuing the bond, obviously I would have to price it along with the market interest rate. Let's say I would go for 12%, the least being that I'm issuing a bond for 12%, and y'all are the investors. I will issue the bond. Y'all are my lenders. Y'all will invest money on that bond, and I will take the money and invest in the project. Now let's say it's a 10-year bond. 5 years down the line, interest rates are declining. Earlier it was 12 to 15% the market interest rate. Now the market interest rate have fallen to, let's say, 4 to 5%, 4 to 6%. Now, who is at the benefit? Is it the issuer or is it the investor at a benefit? Investor is at a benefit. Why? Market interest rates have come down to 4 to 6%, but investor has invested in a bond which gives them an interest of 12%, higher than the market rate. So investor is benefiting. What happens to the issuer for me? If I had issued a 5-year bond, then this 12% bond would have been over and I can issue a new bond for 4%. My finance cost would have reduced. But now, because I went for a 10-year bond at 12%, I am committed to pay 12%. I cannot get out of that arrangement. So who is at a disadvantage here? The issuer. Let's take the other scenario. Market interest rates are 4 to 6%. I am issuing a bond for a project at 4%. 10-year bond. Okay. And you all have invested on it. 5 years down the line, market rates pick up and now it's at 12%. Who is at an advantage? Issuer is at an advantage here. Why? I issued when the interest rate was low. So I am committed to only pay you 4% for 10 years. But investor has lost the opportunity. If he had invested for only 5 years, now he could have used that money and invested in a 12% giving bond. But he's now still committed to hold this bond for another 5 years at 4%. Now, do you see, depending on how the market interest rate fluctuate after the bond issuance, one party benefits and one party loses. Okay. Now, earlier scenario, investor was benefiting. In the second scenario, issuer was benefiting. Okay. Now, to rectify this issue, to ensure that in the first scenario, issuer doesn't go at a loss. In the second scenario, to ensure that the investor doesn't go in a loss, you have an option embedded to the bond. If the bond comes with a call option, you call that a callable bond. If the bond comes with a put option, you call that puttable bond. Now, callable bond, the very first scenario that we discussed. I am the issuer, you all are the investors. I issued at 12%. 5 years down the line, market interest rate has come down to 4%. Who is losing? Issuer. Now, if the issuer has not embedded a call option to this bond, or if the bond he has issued is not a callable bond, then issuer cannot do anything. Issuer has to continue at the same interest rate of 12%, even though market interest rate comes to 4%. They cannot change. But if it's a callable bond, let's say an agent of the issuer recommends to the issuer, look here, 10 years interest rate can go either way. Why don't you issue it as a callable bond? If you issue it as a callable bond, then you have the option to settle the bond early. So issuer, if the issuer had that opportunity where he had issued a callable bond, he doesn't have to wait for 10 years to settle the money. If he now at the end of 5 years, if he knows, oh my God, interest rate has come to 4%, why am I buying 12%? Let's settle this bond and issue a fresh bond at 4%. So if it's a callable bond, issuer has the right to settle the bond early to its maturity. He doesn't have to wait till 10 years. He can settle the bond at 5 years and finish it from there. What is the benefit to the issuer then? His finance cost will be lower. He can reissue a new bond at a lower interest rate. Okay, so callable bond, if you can just mark it next to that, gives the benefit to the issuer when the interest rate declines. When interest rate declines, issuer has the option to settle or retire the bond in full before the maturity, and they have the option to reissue the bond at a lesser rate. Okay. Now, in a callable bond, let's say I'm issuing a callable bond, 12% is the rate, but it's a callable bond. Y'all are my investors. Y'all are looking to invest in this bond. Now, there's another one who's coming with a 12% bond, no call option. As an investor, what would you pick? You would definitely go to the other issuer who doesn't have a call option. Why? You know, okay, this person is coming with a call bond. 12% is not sure. If the market interest rate falls, he has the ability to recall. But the other one, the other issuer is just coming with a 12% bond. It's not a call bond, which means 12% is guaranteed until the maturity date. So if I come with a call bond to my investors, I need to keep in my mind, my investors are also educated, brainy enough. I can't just offer them 12%. I have to offer them a higher rate. I might have to offer them 14%. Why? The investor has a risk. What risk? They have a reinvestment risk in a callable bond. What do you mean by reinvestment risk? Now, before the 10 years, issuer can settle that bond in full, which means I will pay you the money and I will take the bond back. Now I can issue again at a lower interest rate. If I issue at a lower interest rate, what can you do? Now you have no option. You only have money. Now you have to invest that money. Now when you invest that money, market interest rate is 4%. Earlier you got 12. Now because of this arrangement, you are going to get only 4%. So investor, the lending party, is going to be at a loss. That's going to be reinvestment risk. On reinvestment, they have to invest in an interest rate lesser than the previous interest rate. Okay, so next to callable bond, you will write two things. One is callable bond benefits the issuer. If you can highlight this, right to the issuer, it gives the right to the issuer. So it benefits the issuer where they can settle the bond before the maturity. Second point would be it creates reinvestment risk to the lender or to the investor of the bond. Callable bonds tend to have a higher interest rate than other bonds. Why? Because it has investors have a reinvestment risk in that. To compensate for that, you have to give a higher interest rate. Okay. Now we move to puttable bond. Now callable bond, who had the benefit? Issuer had the right. I have the option to settle the bond early and reissue at a much lesser price. In a puttable bond, what happens? That right goes to the investor. What happens here? Let's say I am issuing a bond. This is a fresh example. In this fresh example, I am issuing a bond 4% for 10 years. 5 years down the line, interest rate increased to 12%. Let's say I issued a mere bond. Then for 10 years, both of us are committed at 4%. Okay. So the investor also can't get out of this bond and invest somewhere else. But if this bond was a puttable bond, what happens? Investor has the option to ask for their money before maturity. Now, let's say 5 of you could come to me and say, look here, you're only giving 4%, market gives 12%. We want our money back, we want to put in another bond. Because it's a puttable bond, I'm also obligated to honor that. So I have to give the money to you. I need to settle you early so you can go and reinvest at a better rate, at a higher rate. So in a puttable bond, again, you will write 2 points. Let's say 3 points. One is puttable bond benefits the holder of the bond or the investor of the bond. Why? They don't have to continue their investment in a low interest rate bond. They have the ability to reinvest at a higher rate. Next point, the issuer is the one who's at a disadvantage. Why? I issued at 4%, but because it's a puttable bond, other people have the right, the investors have the right to ask for their money before maturity. If they ask, I have to pay back. If I pay back, I still need to run my project, right? Why? Before maturity, they're asking for the money, which means as the issuer, I have to again issue a bond. Now, when I issue my new bond, can I issue at 4% when the market interest rate is at 12? I will have to issue at a higher interest rate. So, issuer is at a disadvantage where they need to face the interest rate risk. They need to face because interest rate has increased. Okay. Third point is, now puttable bond is a benefit to the investor. Let's say 2 issuers are coming. There's another issuer and myself. I am issuing a puttable bond. Other person is issuing a normal bond with no put option. Which would you pick? As a rational investor, you would understand the puttable bond has a benefit to you. So you will be ever willing to invest in this bond. Why? If the interest rate is not attractive, you can exit at any point. Because the puttable bond is benefit to you, the interest rate of a puttable bond can be lesser compared to the other bonds. Now, if I am issuing a puttable bond and another person is just issuing a bond with no option embedded on it and they're issuing it at 10%, I am coming with a put option. I can issue the bond at 8%. Still, you will be interested. Why? This option has a puttable or a put option embedded on this. This bond has a put option embedded on them. Okay. Therefore, I as an issuer, I can issue a puttable bond at a lesser interest rate. Okay. Understand how callable and puttable bond work and who gets the benefit. Callable bond benefit goes to the issuer. Puttable bond benefit goes to the investor. An easy way that you can, because most of the students, what happens is they know the concept, they confuse with the term callable and puttable. They write the callable definition to the puttable bond and puttable bond's definition to the callable bond. One way that you can remember is, just remember one thing clearly. If I am an issuer and I need to recall the bond back, I have to issue a callable bond. If as an issuer, I am issuing a bond, and if I if I have the right to settle it early, which means I'm going to recall my bond early. Okay, so issuer has to issue a callable bond. Okay, for the buyer, it has to be puttable bond. Remember, for issuer to recall early, they need to issue a callable bond. Then, if you remember that one definition perfectly, it's easy for you to remember puttable bond. Okay. Junk bond and investment grade bonds. Now, junk bonds and investment grade bonds depend on the credit risk rating of that particular bond. Now, last week also I showed it to you. Issuer and issuance both are rated by credit agencies. If let's say my company is A company, ABC company, ABC company is also rated by the credit rating agency. And if ABC company is issuing a debenture, that debenture is also rated by the credit rating agency. Here, our focus, or when we decide whether it's a junk bond, whether it's an investment grade bond, the decision is going to be based on the particular bond's credit rating, not the issuers, the bond's credit rating. If the bond carries a rating of BBB and above, have you seen a rating chart? This is the rating chart. How it goes on from AAA, it goes until D. In some ways, it goes until C. So, if the credit rating is BBB or above, it falls into investment grade. If it's less than BBB, it falls into speculative grade or junk bond range. Now, just by looking at this, what can you comment? Of course, investment grade refers to bonds which are of strong in nature. The repayment capacity, the credit risk is low, repayment capacity is high. So the strong bonds fall into the investment grade. Of course, if it's strong bonds, you are able to issue at a lower interest rate. If the bond falls into the junk bond range or in the speculative range, what does it mean? Credit risk is high, repayment capacity is doubtful, which means higher risk is denoted by the bond's rating. So for such a bond, can you issue at a low interest rate? No. You have to issue at a very high interest rate. People are ready to accept that additional risk as long as the return is also higher. Now here where most students make the mistake is when they see that a bond is triple B rated. They say it's a junk bond. They say it's a speculative bond. No. Triple B or above falls into investment grade. So even a triple B falls into investment grade, but remember, it is the lowest that could fall into investment grade. Okay. Anything below that falls into the speculative grade. So junk bonds, bonds rated below the investment grade or bonds rated below triple B, they reflect high level of credit risk and high level of default risk. Because it reflects high risk, you have to give higher return or higher interest rate so that investors are attracted to that. Who are the issuers that would mostly issue junk bonds? There can be issuers with high debt ratios, very high gearing. It can be startup companies where their repayment capacity is not fully established. Okay, so when they issue a bond, that bond could fall into a junk bond range. Investment grade, obviously, it's also known as a high grade bond. Those have a credit rating of triple B and above. They highlight or they reflect lower default and credit risk, and therefore they can be issued at low interest rate. Floating rate bonds. Floating rate bonds, pretty much very straightforward. Floating rate bonds are where the interest rate of the bond is coupled or is linked to a particular benchmark rate. Like it can be AWPLR. If it's a dollar or a foreign currency bond, it can be linked to LIBOR. Okay. Until the end of this year, we can use LIBOR. Okay. Euro bond, something we saw in our very first lecture series as well, and even I think the week before last, when we did our weekly questions, we had a question on the foreign bond. Okay, so if you had attempted, you can recall them now. Euro bond is where a bond issued in several countries simultaneously and issued outside the jurisdiction of one single country. For example, a UK company issuing a Canadian dollar bond in the Japanese and Australian market. The issuer, issuing currency, and the issuing market all are completely different. Okay. So examples of euro bonds that you can see is euro dollar bond, where euro dollar bond meaning it's a euro bond denominated in US dollars, but you raise this bond not in US, any other country other than US, and by a company which is of non-US origin. Euro yen bond, it's a euro bond issued in yen currency. Yen belongs to Japan, so this bond cannot be issued in Japan. So any other country other than Japan issued by a non-Japanese company falls under euro yen bonds. Foreign bonds. Examples: samurai bond, panda bond, Yankee bond, kangaroo bond. Okay, it goes on. Foreign bonds are bonds issued by a non-domestic company to the domestic market in the domestic currency. For example, if an Indian company comes to Sri Lanka, issue a rupee bond in Sri Lanka, it becomes a foreign bond. If a Sri Lankan company goes to Japan, issue a bond in yen to the Japanese investors, then it becomes a foreign bond. More specifically, it becomes a samurai bond. Okay, remember this table to know the difference. Here, in a foreign bond, the instrument's currency and the country which is issued are pretty much the same. Okay, it's the issuer who comes from a non-domestic background. But for Euro bond market, all three are completely different. The issuer is from a non-domestic origin, and the currency is also of a foreign currency. And it is issued in multiple countries simultaneously. So understand the difference. Risks associated with bonds. Interest rate risk. What do you mean by interest rate risk? We know interest rate and price of a bond are inversely related. If interest rate increases, price of the bond declines. If interest rate declines, price of the bond increases. Okay. Now, what is the risky component? What do you mean by risk? Risk meaning it refers to an uncertainty, probability of a loss. Okay, probability of a loss or a possibility of earning a loss is what is reflected by risk. Now, interest rate and price of a bond are inversely related. If interest rate increases, price of the bond declines. If interest rate declines, price of the bond increases. What is the risk component in this? When the interest rate increases and price of the bond declines. That is what is reflected in interest rate risk. Let's go to our earlier example. You issue a bond at 4%. Okay, issue a bond at 4%. The investors have invested at 4%. But if the market interest rate goes up to 12%, investors are at a loss. Why? Interest rate increases, meaning will there be others who willing to buy this 4% bond? Will anyone want to buy a 4% bond when the market interest rate is 12%? No. So, in the secondary market, the price for this bond will start to decline. Okay. Understand? So, when this declines, investors tend to be at a loss. So, interest rate risk highlights the probability of decline in asset value due to unexpected fluctuation in the interest rate. Interest rate risk is very high for fixed income asset, especially if your interest rate is fixed, interest rate risk is very much high. If it's a floating interest rate, why? Interest rate risk is somewhat mitigated. Why? Because your benchmark rate will also move. Your LIBOR rate will also move. Then your return will also move in the same direction. Okay. There's a small extent of a interest rate risk, but not as much as a fixed interest rate bond. Okay. Credit risk, the issuer defaulting, a risk of decline in the credit worthiness of the bond issuer. What happens? It creates a risk to the bond holder. Why? You might not get your principal back. You might not get your return back. So when the risk is increasing, let's say each year my loss is becoming higher and higher, then you as a holder, you would demand a higher return. Why? Your principal which is coming at the end of maturity is now becoming unsure, uncertain. So you would ask for a higher required return to compensate for that risk. Liquidity risk. Liquidity risk is selling, the risk of selling that bond at a price lesser than its ongoing market value due to low liquidity of the bond. I told you, you have a primary market and a secondary market. Let's say in the secondary market, people, investors who are willing to buy that bond is very less. Then whoever available could bargain at a much lower price, resulting in liquidity risk to the holder of the bond. Exchange rate risk. If I have, as an investor, I have invested in a bond whose interest comes in the form of foreign exchange. When the exchange rate fluctuates, of course, investor is at a risk where on conversion they might get a less amount of domestic currency. Let's say I invested in a dollar bond, my returns are coming in dollar forms. Let's say exchange rate is now further, it's appreciating, it's now going down closer to 100 rupees. When I invested, it was at 200, now it's 100. Okay, let's assume at that. Then I am at a loss. Why? Each dollar I convert, I only get 100 rupees. Earlier, I got 200 rupees. Okay, that's what is highlighted by exchange rate risk. But remember, exchange rate risk hits a bondholder only if the cash flow of the bond comes in form of foreign exchange. Okay, if the cash flow of the bond is not coming in foreign exchange, then exchange rate risk won't hit or won't impact the bondholder. Inflation risk. Inflation risk becomes a risk to a bondholder. Why? Because your investment is in a fixed interest rate bond. Okay, your investment is in a fixed interest rate bond. Your return, therefore, is also fixed in nature. Your income is also fixed in nature. Let's assume every month I only get 5,000 as interest. Okay, every year I get 5,000 as interest. Now February, you could have seen on Facebook so many memes going around. Let's say one biscuit packet was only 100 rupees in February. By May, it has become 200 rupees. Slowly, prices of goods are increasing. But my income is still at 5,000. What happens? I face inflation risk. Why? My purchasing power is continuously declining. What I could buy with 5,000 at the beginning of this year is not the same quantity that I can buy right now. Okay, so inflation risk especially hits the bondholder with a fixed interest rate. Next, yield curve risk. Now, yield curve risk is a specific type of risk which I will talk after I discuss reinvestment risk. Okay, let's move to the last one, reinvestment risk. We identified that when we discuss callable and puttable bond as well. What do you mean by reinvestment risk? Again, a holder of the bond, let's say he has invested his money in a bond which is giving a high interest rate. On maturity, okay, on maturity, when he receives the money, when he receives the principal, he might want to reinvest that money again. On reinvestment, he might not get the same return as before. Earlier, for example, he would have got 12% as the interest rate. But now, let's say that 12% bond is maturing this year. Let's say it matured this year, June. When it matured this year, June, and the investor got his principal back, he would want to reinvest his principal. But now when he's trying to reinvest, what is the market rate? 5%. When it's at 5%, isn't it a risk to the investor? Why? Earlier I got 12%. Now I have to book again reinvest at a much lower rate. If I had continued my investment at 12, investor will be at a much higher profit. Okay, that's what a reinvestment risk means. Remember, reinvestment risk happens where on the interest rate should have declined subsequent to your investment. Okay, after you invest, if the interest rate declines, then you are exposed to reinvestment risk. If interest rate increases, what happens? You are exposed to interest rate risk. For example, you are earlier, let's go to the earlier one itself. 12% bond. Okay, 12% interest giving bond is where you have invested your money in. One situation is that market interest rate now fall to 5%. This bond is a callable bond, which means the issuer can repay you at any time. Let's say issuer repays, you have the money now. When you reinvest, you will only get 5%, which means investor is exposed to reinvestment risk. Scenario 2, you invest in that 12% bond, but interest rate has now increased to 20%. What happens? Others are investing in 20% bonds, but you are still stuck at a 12% bond, which means higher interest rate, meaning price of your bond is now going to decline. You are exposed to interest rate risk. Okay, see how interest rate risk and reinvestment risk actually happens. All right, yield curve risk. Now, yield curve risk is could be a new area for you. So listen to it attentively. You remember our yield curve? What do you mean by yield curve? You should be knowing by now. Relationship between maturity and interest rate of one particular type of a bond. If we take treasury bonds, across the tenors, how the interest rate moves. Okay. Now, this week we saw an announcement coming in. We saw policy interest rates moving up, which means the short term interest rates are now going to increase. Okay. Let's say that increase in short term by 25 basis points or 0.25% happens equally across all tenors. Can you see that here? A 5-year bond also sees 0.25% increase. 30-year bond also sees a 0.25% increase. 20-year bond also sees a 0.25 increase. Across the maturity, the change is equal, which means you have a parallel shift in the yield curve. When a parallel shift occurs, you are not exposed to yield curve risk. You are exposed to yield curve risk if the shift is not parallel in nature. If the short-term rates move at a lesser pace and the long-term rates move at a higher pace, or if the short-term rates move at a higher pace and the long-term rates move at a lower pace, then you are exposed to yield curve risk. What do you mean by yield curve risk? Your margin, because your the yield curve of that particular instrument is not moving in line, not going in parallel, the margin or the spread to a financial institution or to an investor who borrows and invests could contract. Okay, let's see two examples. Ongoing market interest rate at the moment is 3-month treasury bill is going at 8%. 1-year treasury bill is going at 12%. Okay, that's the ongoing market rate. What do banks do? We borrow, we take deposits from short term and we lend to long term. Correct? So let's say I have accepted a deposit where the deposit interest rate is 3-month treasury bill plus 2%. And I have taken that money and given out as a loan where the loan's interest rate is 1-year treasury bill plus 2%. So what is the interest rate? 3-month treasury bill is 8% plus 2 is 10%. So my deposit is 10%. My loan, I have given 1-year treasury bill but plus 2%. So 12 plus 2 is 14%. Which means currently my margin is 4%. Okay. Even to a bank. Subsequently, there is a rate increase and the yield curve has now shifted. But the shift in the yield curve is non-parallel. Let's say central bank has taken a decision and you could see short-term interest rate increasing, but the long-term market is unresponsive. There is no change in the long-term tenor. Due to this, the 3-month treasury bill has now moved up from 8 to 10%. Now my deposit was 3-month treasury bill plus 2%, which was at 10% before. Now, because the 3-month treasury bill has moved up by another 2%, my deposit is now going to be at 12%. I have to pay 12% on my deposit now. Why? The short-term interest rates have moved up. But long-term, there is no shift in the yield curve. So my loan is pegged to the 1-year treasury bill. There is no change in the 1-year treasury bill rate, which means it's still continuing it at 14%. So, due to an unparalleled shift in the yield curve, where the interest rate change has not gone parallelly or equally across the maturities, the margin earned is going to contract, is going to reduce by 2%. Okay, just an example on a working example on how the yield curve risk hits to a investor or to a bank. Okay. Now we move on to particular types of bonds. Let's start off with treasury bonds. We studied treasury bills in money market. Treasury bonds are medium to long-term debt instruments issued by the government. But here the main purpose is for their development project. The focus is to finance their development projects. Okay. Now for treasury bills, we saw specified tenors. We saw 3 specified tenors. Here, can we see like that? No, they across the board, it goes between 2 years to 30 years. Okay, across that timeline, maturity line, you can see several treasury bonds being issued. Treasury bills we saw as discount pricing instrument. Why was it discount pricing? I told you, because that instrument was a less than 1 year instrument. They issued it at a discount pricing. It had a face value, but it got issued as at a lesser price than the face value. Treasury bonds are not short-term instruments. They are going to carry a tenor of 2 to 30 years. Here, treasury bonds are going to be interest-bearing bonds or interest-bearing securities. Add-on interest method is what they would use. Okay. Here, interest payment happens biannually. Every 6 months, the interest is paid. Interest is also called as coupon when it comes to treasury bonds. Okay. Just like treasury bills, treasury bonds also, if they are issued by the government in their own currency, they are considered to be the safest of all instruments. Why? Default risk free. Issued in their own domestic currency, they could print at any time. Again, just like treasury bills, who are the issuers? On behalf of the government, you have central bank issuing the bond. What particular department of central bank? Public Debt Department, PDD. Public Debt Department issuing the bonds, and they monitor the interest payment and the principal payment as well. Okay. Again, similar to how treasury bills work, you have a primary and a secondary market. In the primary market, you have primary dealers stepping in who would subscribe for the treasury bond and subsequently sell them or trade them in the secondary market. From 2004, both treasury bills and bonds were converted into paperless form, and all their trading happens electronically through Lanka Secure. All right. So how does treasury bond trading happens? Treasury bonds could be purchased, especially in the secondary market, anytime from the primary dealers and licensed commercial banks. How come licensed commercial banks are allowed? You know, they also are acting as primary dealers. Okay, so even through them, you could buy. Primary dealers are the appointed dealers, so who are allowed to act on government securities. Okay, how can you buy treasury bonds? You can buy from the primary market, from bidding at the primary auction, through a primary dealer, or you can buy it at the secondary market. Okay. What are the features of treasury bonds? Risk-free, gilt-edged debt instrument. You call them gilt-edged due to the government being, it's a government security, hence termed as gilt-edged debt instrument. Maturity ranges between 2 to 30 years. Coupon or interest payment happens biannually every 6 months, and principal is paid on maturity. So imagine a 30-year bond. If you invest 100 million in a 30-year bond, you will get your money back, your 100 million back in 30 years time. So can you for understand an individual investor investing for 30 years? That's what I said. Even for debt capital market, very rarely you would see an individual investor stepping in. Mostly you find institutional investors who invest in these kind of instruments. Treasury bond is a tradable instrument. Why? It has a secondary market for itself, and this secondary market is very active and liquid market. Why is it active and liquid market? Of course, due to the treasury bond being a government security, there's always demand and appetite for these instruments. And this instrument is issued in scriptless form. It's not in a paper form. Electronically, the issuance happens. What are the benefits of investing in treasury bonds? Of course, the risk-free nature of treasury bonds, because it comes with a government backing. You know for certain your principal will not be defaulted. You have that guarantee coming in. So that's a benefit when you invest in treasury bonds. And that's one. If you know, when you put your money in a treasury bond, you will definitely payback is guaranteed. Another benefit is, let's say you want to liquidate your investment. You want to recall your money back urgently. You know that there is a secondary market which is active and highly liquid. So there are other investors who are willing to buy this bond. Okay. Therefore, a good secondary market being available is also a benefit when it comes to treasury bond. Okay. Receipt of interest and maturity proceed is certain. You know for sure interest won't be delayed, interest will not be, let's say, will not be forgotten, will be asked to pay later. No, you know for sure your interest will be received and your maturity will be credited as agreed. Finally, the platform in which you trade, your trading process is very much simple and easier when it comes to treasury bonds. Now, in the second point, I told you liquidity is very, very high for treasury bonds. On general, I'm talking about across all maturities, you would see a good appetite when it comes to treasury bonds. Why? There is always someone who's willing to buy it, because they could definitely use it for repos, reverse repo and whatnot. But sometimes for certain maturities, the demand can fluctuate. For example, take a 30-year treasury bond. A person who has an appetite for 30-year maturity is very less. Okay, so even though treasury bond, the level of liquidity could change according to the maturity in which you're targeting. Okay, just for you to understand how the practical market works. So you have three particular systems coming in that you need to know when it comes to treasury bond. Lanka's secure system is the broader concept. So Lanka's secure system consists of these two: scriptless security settlement system and central depository system. You need to be aware of these three. Okay, Lanka's secure system manages and facilitates the issuances and the subsequent secondary market transactions relating to these securities. Okay, first time on issuance, who is buying it, and when that party resells it, to who do they resell, what part of it they resell, all the recording is maintained at Lanka secure system. Not only that, even the settlement is handled through Lanka secure system. Now, for you to record and settle, there are two particular functions, right? So for that, you have two dedicated systems. You have scriptless security settlement system and the central depository system. What does the scriptless security settlement system do? They do the settlement through electronic settlement arrangement. Okay, here the settlement for the security is done instantaneously through electronic means. When the transaction happens, the settlement also occurs. Okay, here when the security moves from one person account to the other one, the settlement happens instantaneously. Okay, what does central depository system do? It's like a database. It has the updated records on who is holding what security. The CDS maintains the accounts of the primary dealers and the individual investors who invest in these government securities. Okay, so CDS updates when a transaction say, okay, this person sold and another person bought. So CDS would update the selling and the purchase immediately. Scriptless security settlement system, what do? They do the settlement. They deduct from the person's account and they deduct the security from one person's account and credit it to the other who purchased it. Okay, so CDS will get you an updated database on who is holding what. Scriptless security settlement system does the settlement of the transaction as and when the transaction takes place. Okay, that's the function of these systems which support the treasury bond. Remember, Lanka secure system is the broader name that consists of the CDS and the scriptless securities settlement system. Then we have Sri Lanka Development Bond and International Sovereign Bond. Now remember, even in the last class when we talk about money market, I keep saying you, if the government issues a security in their own domestic currency, credit risk is nil, no default risk, safest of all instruments. Why am I saying you that? Because yes, there are instruments which the government can issue in foreign exchange. So these two, Sri Lanka Development Bond and International Sovereign Bond, are two instruments issued by Sri Lanka which are denominated in foreign currency terms. Okay, specifically US dollars. Okay, so we are going to learn the characteristics of these two bonds and how these two bonds differ. What's the difference between a Sri Lanka Development Bond and an International Sovereign Bond is what we are going to look at next. Okay, it will take some more time, so we'll finish off from this particular point and start off next week from this point. After that, we will move on to Sukuk bonds, where we'll talk about what the Islamic bond does, how it has both debt and equity features embedded on that. And then we'll finish off with debentures, what debentures are and what their characteristics. And then we will move into like the heart of the lesson, bond related terms and bond valuation. So bond valuation would have a lot of calculations available for you. Okay, so all these parts are yes theory, but now you get ready for the calculation part of the lesson as well. Okay, Thank you so much for listening in. So we'll next week join in and start from Sri Lanka Development Bond. All right. Again, tomorrow, as usual, you will get the papers being sent out to the emails that you have shared with me. If you have not shared your email address before, please do this particular email that I share. The corrected papers, some of them I've already sent across. There is some balance left. I will send it off today after the class. And then again tomorrow you would get a fresh set of questions being given out to you. Okay. Thank you so much for listening in. We'll meet again next week. Okay.